As the Delta variant becomes dominant worldwide and forces some countries to reimpose restrictions, we ask a crucial question. What impact on consumer and investor behavior will COVID-19 and its existing and future variants have in the long run? The good news is that most experts agree that current vaccines are highly effective against severe disease caused by all known variants of the virus. The links between cases, hospitalizations, and mortality have weakened in places with the highest level of vaccinations, such as Singapore, Canada, the UK, Germany, and France. In the UK, which had the first experience of Delta outside India, cases surged sharply after football's European Cup in July. The situation has stabilized quickly in a country where close to 2/3 of population has been fully vaccinated. The ratio of deaths to cases has fallen from about 1 in 50 during the winter wave to 1 in 750 in midsummer. Whilst Europe and Canada have successfully started to reopen in less vaccinated parts of the world, the worst phases of pandemic is occurring now. The exponential growth in cases affects countries the most when vaccination levels are insufficient to prevent new waves of death, especially Southeast US, Latin America, and Southeast Asia. In the rich world, zero-COVID countries such as China, New Zealand, and Australia, which coped so well in earlier COVID waves, are seeing renewed restrictions due to relatively small outbreaks. These countries face a transition. They will have to remain closed to inbound visitors until vaccinations are high enough, and then must inevitably accept some low level of cases accompanying the reopening of borders. Singapore and Australia have recently laid out plans to reopen borders once vaccination rate is high enough to shift the focus of concern from cases to hospitalizations. That said, political reputations have been staked on zero cases, so accompanying shift in mindset might not be easy or immediate. Because the Delta variant is more infectious than the original virus, it manages to breach these countries' once airtight pandemic defenses, making it clear we likely will not be able to eliminate the virus worldwide. This does not mean that the pandemic will go on forever. Rather, the virus will become endemic, meaning widespread with the population, but manageable with a fourfold combination of vaccination, contact tracing, treatments, and occasional rounds of social distancing.
What does this mean for economies and for real estate? A more gradual end to the pandemic, characterized by attenuating waves, may result in more of our new habits, the new normal, being retained for longer. The return to the office will also be slowed in countries where it has not already occurred. Many firms targeted September for returning to their offices, but several high-profile ones have announced they are delaying their plans by at least a few months. The virus's transition to endemic status will also impact the data we track as followers of economies and markets. Vaccination and hospitalization rates should take over from case rates to become the key metrics in predicting a return to normality. But from the point of view of long-term investors, waves of the virus will diminish as the outlines of the post-pandemic world become clearer. That said, the Delta variant represents a major setback for a speedy return to pre-pandemic normalcy. This reinforces our view that some aspects of economic and social behavior are likely to take longer to recover than many imagined 6 months ago.